Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Our guest for this week's show is real estate investment expert and best-selling author, Ken McElroy. Now, for over two decades, Ken has experienced great success in the real estate world, from investment analysis, property management, to acquisitions and property development. With more than $3.8 billion of real estate purchased in the last 2 decades, Ken offers a unique perspective on how you will get the biggest return on your investment dollars. Ken's group, MC Companies, seeks investment opportunities in the Southwest region of the U.S. with a heavy focus on the acquisition of Class A multifamily or Class B with value-add opportunities within high barrier to entry markets. And so, guys, it is my honor to welcome my guest for today's show, Ken McElroy. Ken, how you doing, my friend?
Awesome, man. Great to be on your show.
Yeah, absolutely. Excited to be catching up here with you. And, we were chatting a little bit before we started rolling here just about kind of the craziness over the past year and a half. So real excited to really get, an update with you and your companies, but also your perspective on, where we're at today, where we're heading in the future. Again, if you could dust off that crystal ball, we'll do that here in a few minutes. But before we dive into the meat and potatoes, Ken, if you would, for those that might not be familiar with you and know who you are and what you do, maybe take a few minutes and give us a little bit of a background if you could.
Sure, I'll give you a quick version. So I grew up in Seattle. My parents did not go to college. I went to college on an athletic scholarship, and I started managing properties, to help pay rent. And one day the owner came in with a nice car, and I'm like, I am on the wrong side of the desk. So how do I get on the other side? And I started to study, learn, get my real estate license. I worked for a local company up there. It was a blessing. 10 years in property management, and I learned a lot. I managed for hundreds and hundreds of clients. It was a big company, but now a big national company, and I was based out of Seattle. And then I decided, okay, I need to start buying more and more and more of these. I started with my own capital, like we all do, and all of a sudden I ran out. And then I started syndicating, and next thing you know, this is back in the 90s, so I've been buying real estate and managing real estate apartments primarily up and down the Northwest, and now I moved to the Southwest. I live in Scottsdale, and my company, MC Companies, now we have about 250 people, full-time acquisitions, property management, construction. So I have a construction company, development company, property management company, and we are very active, as you know, in primarily Texas and Arizona. And we have a really good culture. That's what I've been focusing my last 5-6 years on. We've been rated the top employer in Arizona, the top 100 for multiple years in a row. And, we're really proud of that. So it's been fun, and I'm getting tired. I'm having fun though.
That's awesome. I appreciate that, Ken. And, you brought up a point as you kind of were going through your history, your background, your bio was, you started syndicating back in the 90s. And I don't even think the word syndication it wasn't even a well-known phrase, right, at all. In fact, I remember we started looking at doing syndicated deals back in like 2008. And you couldn't, there wasn't, it just wasn't, you had to know somebody that knew somebody to actually even get the inside scoop of how to actually structure one of these deals, or go to a securities attorney and find someone that actually had been down that road before. But it's a common phrase and terminology, and there's an understanding, and there's multiple resources on the topic. And back then it just wasn't the case, was it?
No, it wasn't. I will tell you this. So, but being in property management helped a lot, because what would happen, Kevin, is like I would be, let's say I'd be managing a 300 unit building in Seattle. There would be 8 or 9 guys that might show up, and they were all doctors, lawyers, whatever. And they had thrown a bit of capital in, and then maybe they were a property visit. So as a property manager, I was kind of, I was showing these folks around, and sometimes it would just be the person, the general partner, and so I didn't always meet everyone. But I did the same thing with a guy that started with a bunch of Microsoft money, because I grew up in Seattle, and back then it was not uncommon for, in fact, one of my good friend's moms, was Bill Gates, one of her original secretaries, got all these stock options, and So during that time, watching, Microsoft at the time, there was a lot of capital, and those guys were investing in apartments. And so I did not grow up around this. So, like I had no clue what to even say. I wasn't involved in country clubs or anything like that. But I was kind of around it in the property management world. And so I did kind of understand loosely how it all worked. And of course, I figured it out.
Yeah, no, I was trying to look at my bookshelf over here. There was a book. It's been around for a long time. It was probably the original book on real estate syndication. I think it's Samuel K. Freshman. Does that ring a bell?
Yeah.
He's been around for quite some time
Yep.
writing about
Yep.
syndication. So,
Yeah.
yeah, well, we were chatting, and I thought it was 2020. You corrected me; it was 2019. About you sold off a fairly large chunk of your multifamily portfolio. I know you bought a lot since then, and I know that you're a huge proponent of infinite returns. Cash out refinances, tax free, and keep that investment rolling forward, and ultimately get to the point of getting your original capital back, and again creating those infinite returns. And so, I guess my question would be based on the sale of, I believe it was 10 properties you had mentioned, 10 multifamily properties, where we're at today. No one knew where we would be looking back a year and a half, to where we are today, with the market just being on absolute fire, cap rates compressed across the board, double-digit rent growth rates in many of the different Sunbelt markets. And so, are there any regrets? My one big question: are there any
Yeah.
regrets on the sale of that portfolio?
Well, sure. Let me back up, and
Yeah.
I'll tell you on the why. So at that time we had hit right around 10,000 units, and so as you look at your list, let's call it 40 plus properties.
Mm-hmm.
There's always those 8 or 10 that require all your attention. Right? Always. It doesn't matter. I mean, you have it, I have it. Like we still have it, right? But so my partner and I were like, and by the way, these were deals that we thought were going to be great. And some of them we had bought from banks. One in particular, actually multiple, we bought from banks that, back in the day. And the needle wasn't being moved too much. In other words, we cleaned them up. One of them, we put a lot of money into, and it was just in a tough area. And so back then, we were buying us in some cases banks' assets. And the area was just, they were tough. They were not areas that we were going to see big rent growth. Maybe they had higher crime that we wanted, that kind of stuff.
Mm-hmm.
So we started, and when I say issues, all of that, the management stuff kind of turns into the return, as you know. And so we just kind of went through each one. And some of these were in markets that we didn't feel were going to move, like Oklahoma City, as an example, is a good market that still is flat. So that was one of the markets we pulled out of. We sold a couple in Tulsa, and one in particular was in a really bad area, Houston. So those were the 10. So they weren't,
Okay.
I wouldn't call them the cream of the crops. So, and the other thing that we did before I said, okay, to the management company, if we spend, so much money on these interiors and do value adds and all that kind of stuff, where are we going to be based on, let's say, a 3.5 to 4 cap? Because that's essentially, we sold them under a 4 cap. And they said, well, we're not going to ever, because we had this much equity and we're getting this kind of cash flow, right? So I said, well, okay, let's take a look at that. So we decided to figure out what they were all worth, and they were worth way more than we thought they were. So Ross and I and my partner were sitting on all this equity. So when people ask that question, because I've been asked that question, what they don't know is that I did a 1031 on the bulk of my capital gain issues into 4 more. So what I did was we got rid of some of and I still believe those are the right ones to cut. But then I took the ones that, we had a fair amount, because I didn't want to pay taxes like everyone else legally. So we ended up doing a pretty complicated recap of 4 other deals where we rolled the majority of interests. We had to put them into a TIC, or tenant in common, and then put them into a new limited partnership into 4 others. And so really we just moved the money into 4 others that have done really, really, really well. So if you look at the whole thing, I think we did pretty well.
Yeah, no, that's fantastic. I appreciate you adding some additional context there, and I'm assuming that the timing of the 1031 into 4 different properties. It's brilliant that you pulled it off, but I can't
Yeah.
imagine the additional stress and anxiety that was created along that period of time.
Well, yeah, you know what happens with it, the mistake people do with the 1031 is that they put everything in escrow and then they go, look, we were looking first. We had negotiated a 4 property deal at a 6.5 cap, if you can believe
Wow.
that, in 19. So it was basically a 6.5 cap, and it was a value add. And I think it was around, they were a couple, 200 to 300 units each. So, call it 1,000 units. And so we exited about 2,000 units, and we rolled the bulk of our capital gain and our profit into a nice value add 4 property 1,000 unit portfolio at a 6.5 cap.
Oh, that's
So we
beautiful.
did really, really, really well.
Yeah.
But the point was is that we had that set up before, we didn't have the gun to our head trying to save tax.
Yeah, no, gotcha. I want to ask a few more questions about that portfolio. So you selectively chose, I guess the underperformers, right? The lackluster properties in your
Yep.
portfolio. We all have them. We all have them, and anyone listening to this can name off the ones that are in their portfolio
Yeah.
that drive them crazy, or you'll take 80% of the time. Um, and so my question, this is always the question. You know, was it a MC company problem? Was it a market problem? Like, and what I mean by that is the next person in line, the person that acquired them. Is it just a matter of them throwing more energy and dollars at it, or is it just a sense where there's always someone out there who thinks they can do a better job than you? However, more than likely they probably can, and it just you can't change the market. You can change a property, you can make it look beautiful, you can
Yeah.
throw renovation dollars into it, but if it's on the wrong corner, it's in the wrong school districts, it's in the wrong market in general, there's no fixing that, no matter how many dollars you throw at it. And so I guess again, just throwing that out there as a generalized question, what are your thoughts on that?
Well, you hit a very, very, very interesting question. So on this particular portfolio, one of those properties, if you can imagine this, I'm the seller, and I got solicited from the actual buyer that we picked with their business plan. So they don't know I'm on a list, like you, like I look at deals and I invest outside of my own company too, because
Yeah.
I think it's a great business. So I'm on the syndicator list. Somehow I get the business plan on a building that
That's
we're
pretty
actually
funny.
selling. So what does it say? Horrible management, lots of room in the rent. We can cut expenses. Da 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 da. And so my partner and I, Ross, we were laughing. I go, check this out. And the point is that you can pretty much put whatever you want in a business plan.
Yeah.
And I'm telling you, I hope they did it. I completely hope that they were
Sure.
successful. I don't want anyone to ever lose any money. But from our standpoint, we had decided, and we had held these properties for 4 or 5 years, 6 years, and we were like, gosh, we're not moving the needle much. And we even actually did some renovations on some of the units to see if we can raise the market rents, and we couldn't. And I know one in particular was a smaller size, like 125 or 130 units, which is a lot smaller than we normally buy. And so you kind of have some issues around the operational expenses and that kind of stuff. So like a manager on a 125 unit building gets the same pay as a manager on a 250 unit building. You know what I
Yeah.
mean? So
Yeah.
so all those things came to play. And so, yes, the question and the answer, what you just asked me is there's a lot of people raising money based on, the future. And
Yeah.
my hope is that they don't lose anybody's money.
Is it you bought a lot of these properties, many years back? You had really low basis in them. Compared to what they sold for in recent times. You'd mentioned a number of them were from a bank, and was it when you looked at these deals back then? Were you looking at it from a through the lens of, well, there might not be a lot of room to run. However, we're getting it at such a low basis, such a low dollar per unit, or maybe it's below replacement cost. I don't know what the metrics were, but was that part of the allure of those particular years? Like, you knew they weren't in the best market, they weren't in the best neighborhood per se. Maybe they wouldn't fit your criteria today, or they probably wouldn't. But like, you were getting into them so cheap that it was almost impossible to lose. Was that the mindset?
Well, they were actually, no, we were way into the money. So the issue, it's kind of like what people are dealing with today. I would consider a lot of people, house rich, but cash poor.
Mm-hmm.
They have a lot of equity in something, and we all know what that's like. That could be a business. I bought a resort in Sedona, and it was 12 acres right on Oak Creek, and the owners that had it, they had owned it for 42 years. And they were making it work, and but they were putting just a little bit to their bottom line, and they were getting tired. They had a staff of 20 something, but they were rich, like the actual site, the property, and all that stuff. So this happens a lot. Sometimes you can have a company or a property where you have a lot of equity in it, but it's just doesn't produce financially, what it should. And so for us, each one was one of those things. They were even at our basis. So, like we had 1031 buyers, and we had people that put funds together, and they were just, crazy. I mean, you can imagine we put it out with CBRE. It was called the MC portfolio. And we had, I don't know, 3,000 to 4,000 people look at it. And, so when you start to, not everyone bid on every property, of course, and then we ended up breaking it up for a better price. But we originally wanted to sell all 10, and that ended up not being the highest and best use for our investors. And so we broke it up, and we sold them off individually based on, maybe whoever was buying at the market at the time. Sure. And we were 3-4 times higher than what we paid. So we were happy, leave a little more room on the, on the bone for the next person. It's totally fine with us,
Good deal. And last question, then we're going to move on, is identifying, the great performers from the potential turds, right? That's the terminology. We use it in house, but it's probably it's not politically correct. But anyway, you know where I'm going with that. So what shifts have you guys made in your business? Again, we're not going to use these as an example, but just what disciplinary strategies do you are in house to pick the right ones from the potential losers?
So part of that 10 property portfolio sale, because as you know, we're typically holders, you have to actually ask yourself that question. What was good and what was bad? What did we miss here? Mm-hmm. And one of them we over improved for the market. Just, I mean, you would never think it. 2-story garaged, townhomes type units. And so there were, so what you start to realize is that almost all of them, the first issue was location. They were in areas like, I think you said it earlier, that you no matter what you do on the management side, no matter who you hire, no matter how good they are, the clientele that's coming through the door, mm-hmm. It is what it is based on the market. So you can't outperform the market. And so that was probably one of the bigger things. The other thing was that you can't really over improve something for the market that you're in. And, so we got a little over our skis on improving, on doing some improvements, because in some of these markets that had, we'd call it a rougher clientele. And by the way, this is not indicative of our whole portfolio either. So, most of our stuff is Class A. We build our own properties, and most of the stuff is repositioned Bs. And so these were, I would say, Cs that were maybe we thought might be Bs, but maybe still stayed Cs. Yeah. But we were getting them for such a low cost, from the banks. We were buying from banks at the time. These are things that had gone back in 6, 7, 8, and we were actually buying them directly from the bank. And so what happens sometimes, you compromise. You're like, well, we know this is kind of a rough area, but let's see what happens. And so we did very well, but man, it was just a, management intense. And so I would say over improve and location were probably two of the biggest things
Got it.
that we learned.
Yeah, no, fantastic. I appreciate that. And fast forward to today. Tell me about
Yeah.
what's happening with MC companies. Where are you guys? What are you focused on, and how are you? How are you planning for the future? Yeah, right. It's
Yeah.
and it's again, if we look back, we were having this conversation June of last year, May, June of last year. It'd be a very different feeling than the feeling that we have today in present time, right? Of what the future is going to hold, and no one really saw what ultimately has turned into be just a very liquid capital environment. Compressed cap rates across the board, and just I don't know. Just I'm still in shock. There's a shock and all factor here, and none of us know what the future holds. So I guess again, what exactly are you doing, Ken, personally and professionally, to prepare for the
Yeah.
future, and what do you think that future holds?
Well, thank you. There's a few things. If you, I love the quote Gretzky uses, which is, why were you so amazing? And he said, well, a lot of people skate to the puck. I like to skate to where I think the puck's going.
Yeah.
So we use that a lot in our company. And because it's really hard to figure that part out. And so there's a bunch of factors, especially with this pandemic, that have changed migration, for good. One is political. Obviously, we were having a little chat about that, but you're going to start to see the policies for being a landlord, or even property taxes or whatever it might be. I think are going to shift people's views on where they want to own stuff, and then so you have that, but then you have the weather, you have the safety issues, you have the work from home issues, you have all those other factors on where people actually want to be. So all of that before the pandemic, believe it or not, it was a little easier because we're like, okay, here's a here's the a big employer, let's say, and like Google or Twitter or whatever. Okay, we know that these people are coming and going to work every day. Well, that's all changed now. So now that's kind of created all these bubbles in these submarkets. And so part of what we're trying to do is we're trying to figure out where, we have to meet people where they're at and then take care of the demand where they're at. At the same token, we don't want to be too heavy in a small submarket, that could pop like that, because I've made that mistake too with like a military base deployment or something like that, which can totally change a market. And so we've settled on some of the bigger markets, but also on where the states that have been a little more friendly, like Texas as an example. And so we start, then you start to dig in a little deeper, like where in Texas, because it's a big place.
It is.
And so there are areas in Dallas, areas in Houston, San Antonio, Austin. We just closed on a deal in Austin on Friday, 455 units. It was basically a $90 million deal. And so we want to be where we think people are going based on jobs and population growth and safety and freedom, whatever you want to label it. But and that's been a chore to try to figure that out. And we're constantly like challenging ourselves, like I hope we're right, but we're reading and just devouring stuff. But then we have boots on the ground in all those markets too. So it's been a process.
Is it more related to when you speak of like maybe a sub-market bubble? The migratory patterns have definitely shifted towards nicer climates. Folks have been able to now choose, depending on what company they work for, they've been able to choose to live somewhere else, not necessarily exactly where that company is. Some companies are saying now you got to come back in. Is part of the fear that those migratory shifts or patterns some of them might get reversed, where people they move to a place they thought they wanted to live, they enjoyed it. However, now they have to make a choice of either find a new job or go back to where they came from. Are you seeing any of that occur?
I definitely think that could be a potential. The one thing that we're seeing is, they're calling it the great retirement or resignation, the great resignation. I think like if you just look at Austin, which we've owned in Austin since '05. There's so much happening down there, man. It's just like crazy. Now I know housing prices and all this stuff, but you start to look at these companies that are popping up all over the place. And so what that does, I think, is it gives people choices. And so if, let's say you move to Austin and you work for somebody in California, as an example. Well, if they say you got to come back to work, you're probably going to go look at what's going on in Austin, as opposed to relocate back to, that market. Not always, but in a lot of cases. And so we try to pick markets that have a lot of diversity. The other thing that we've done is we also have been focusing around healthcare quite a bit. Mm-hmm. So, if you look at the aging boomers and you look at, what's happening with all of that, and of course, the pandemic just made it even more so. We think that anything around a hospital system or anything like that, any medical, is going to be pretty good long-term. So the stuff that we bought recently has been around those two things. The Texas Medical Center, as an example, in Houston. We were literally across the street. We bought 648 units there about 5-6 months ago. And, and so, and we could be wrong, as but it's full of people that work and walk across the street to work, So, but, that's what we've tried to do, at least.
Are most of what you're buying today, are they stabilized A-class assets? I mean, are you putting fixed rate debt on right from the front, agency type debt, or?
Good question. Really good. So if it's a reposition, which we try to get some value add. So the one in Houston, as an example, is so odd situation. But what happened was, you remember when they had that hurricane there and the dikes got, they got up to the top. They go, we're gonna have to release the water. So what they did is they released the water, which would have been not quite 10 years ago, I guess. It flooded everything in the valley, of course. So everything on the first floor was redone on this property. We bought 648 units, as an example. So you can imagine, granite, countertops, stainless appliances, basically a value add play through insurance on the whole first floor. The whole second floor were classics. So you can just do the math, and they got 300 units that basically were, on the next 10 feet that, we had $180 to $200 a unit, and we already knew because the first floors were that much more. So that's a value add. And so to answer your question about the loan, so what you do is we'll do a bridge loan. Mm-hmm. And because bridge loan doesn't have that big exit prepayment penalty on it. So you do what's called a short-term bridge loan. So maybe like a 3-year bridge loan, which is not going to take us 3 years, but you to renovate those. And then what you do is you increase all the rents on the remaining 300 plus units. And then you go back to the bank once it's all packaged, once you get the expenses dialed in and once you get the rents back to where where they potentially could be, and you spend all the money on the property, then you go back, and that's when you do your cash out refi. Mm-hmm. And that's when you return a bunch of the investor equity, of course, tax free, because it's a refi, and you don't pay debt, or you don't pay tax on debt. And that's when you put that long-term fixed rate debt on there and lock it.
And what do you, assuming like a project such as that one, using that as the example, that it might be a 2 to 3 year. Obviously, you've got 3 years to do it. There might be some extensions, but my guess is that you guys you plan to get it done within that 3 year span of time. What are you factoring in, or what are you underwriting as far as interest rate expansion? I mean, is it 10 to 20 bips a year? How do you making that determination or guesswork over the coming years?
That is the risk, without a doubt, is interest rates. What are their interest rates going to be in 36 months? Yes, we run modeling for all of that, but it's impossible to know. Mm-hmm. What I do know is this. Our bridge is, it definitely has renewals to it. It's at 3.5 and fixed. So my bridge is at 3 during that period of time. And the race against the clock is to how do you renovate 300 units in 2 years? You can do that. I would say 60 to 70% of those units turn over in 1 year.
Mm-hmm.
And that's the pretty normal turnover is around 60 to 70% depending on the market. So you catch the rest in the second year. So so for us, it's all about interest rates. So if we think interest rates, we're going to start to see them up. And I actually don't think they're going to go up, because if they do, it's going to really mess up this economy.
Yes.
So that's complete luck, though, as you know, because I've been on both sides of it, where they've gone up on me and we've locked, and they've gone down. And so,
Yep.
it's one of those things. But the one thing that never changes is my cash flow. So what I do know is I'm going to have at least 300 units times $200 more a month coming in, than I did before if I run the property well. And so it might be that I can't take as much out on the cash out because of the interest rate, because they always solve to the debt coverage, as you know,
Yep.
for whatever the NOI is, net operating income. So that's always one of those things where you just got to kind of watch,
And on a value add project such as that one, is it you renovate the units once they turn? Do you allow just for the organic turns, or do you guys ever do a forced non-renewal?
Oh gosh, no, yeah, we want to keep people there.
Okay.
Yes, for sure, but we also want to upgrade the units.
Yeah.
So it's a fine balance between all of that, as you know, and that's we own the management company, and it's our management company, and so if rents are going up like crazy in Houston, so one of the things that we would always want to make sure of is that they're well communicated to. And by the way, this property is built in the 90s, has 9-foot ceilings, and they're townhome units, and so it's not like they're in bad condition, right? They're already very, very, very nice. Between the two of them, I think there's like 6 or 8 pools and fitness centers and all that kind of stuff. So these are nice communities, and they're gated and all that. So just converting them over to what we consider to be a classic unit, which might be 20 years old, is fine. But we might do a 6-month or an 8-month lease with them for a shorter period, depending on our scheduling for the renos. But at the end of the day, what we really want to do is we want to do the renovations. One of the low-hanging fruit things that we like to look for, and was definitely a situation on this property, was that they had the original developer had put in washers and dryer rooms, like actual laundry rooms, with the hookups and everything. So you have the water for the washer and the dryer venting and all the electrical for that, but they didn't have the machines in there. So for $1,000 a unit, we put those in regardless, and we already get $50 for that. So now, and it's a trade-off for the resident, because the only difference is they don't go down to the laundry room. And so they're still spending that kind of money on laundry, but now they can do it in their own home.
Yep.
And so it's not really out of pocket a lot more for them. And so that was one of the strategies on the value add. And then the rest, of course, is a bunch of the interior work.
Got it. So I know you'd mentioned that you've got some ground up projects going on. You've got a full development side of your company, but you also, as we're talking to you, buy existing products. What at this point in time, how do you make that determination of ground up in this market or existing?
Well, so we've been doing ground up a long time, and we're a general contractor. So it's a really, really good question. So here's how we evaluate it. You always want to try to do land banking when things are bad. So, call it 08, 9, 10, 11, 12, right? That's when you want to start buying land, because, and you have to have the means to be able to hold it. And in the multifamily side, that might be 10, 12, 20 acres, depending on the city and what they allow you to build on that. And so that's one strategy. So your land basis is low. And if you can, you want to pay attention to what does it cost to build. So let's say in mid 2000s, it was $150,000 a door to build, and you were buying at 100. So, so you kind of take a look at that, let's say, and that's very different now, but let's say it's you're buying at 100 a unit and you're building at 150. You have to take a look at the difference in the rent and the payout and all that. So it's just math at that point. But when you start to build cost goes to 200 and you're buying at 100, you might not build, but when the cost to buy goes up to 150 and the cost to build is 150, and that's happened, then of course it makes more sense to build. So because now you're getting more rent for what you're buying, and so you're constantly looking at that, the balance between the replacement cost, and so that's going on right now between Phoenix and let's say Dallas. So in Phoenix, let's say you could we built a property in 2015 that we got an unsolicited offer for $80 million, and it was like 320,000 a unit. And I think we built it for like, I don't know, 100 and something, 150, let's say. Now, we could buy a 2015 property in Dallas for less, right? So right now, a 2015 property in Phoenix is, let's call it 325, 320. Well, that exact same property, if you take it and just put it there, with the rents are all similar, and I understand there's differences with the expenses and all that, you might pay 250, 260. So when I'm looking at markets, like in our Houston properties, our all-in cost with renovations is 180 a unit. The deal that we just closed in Austin, Texas, of all places, 17-year-old property, when it's fully renovated, we're going to be about 185 to 188 a unit, all in. Wow. Now, if we were to build there, we would be close to 400,000. So I'm always looking at the difference, and then you have to overlay the rent, of course, and the math behind it all. But so, but we always, that's kind of our no go, do we go or no go? We're always looking at that. We have 330 units under construction. We have 4 more projects, all in Arizona, that we'll break ground on, in the next 24 months. And, but, even last week, my partner's like, construction costs are getting up there. Maybe this is a piece of land that we hold for a while, because we can buy in Houston at under 200 or Dallas or in San Antonio or Austin even. And, we're going to be building at close to 250, 300 a unit. So, and we're always, the missing component, of course, is the land, the operating expenses, and the rents. But you always have to look at that. The math solves itself and kind of tells you what to do every single time.
Yeah, no, absolutely. I appreciate that context there. And, and real quick before we move on, I'm on a lot of the different, passive investment lists as well. And I see a lot of these, I've got a lot of LP investments and personally and multiple different operators, but I and I'm not a multifamily expert. We're in manufactured housing, but there's a lot of similarities.
Yeah.
And, I see what looks like a very significant imbalance in the C grade products that are out there. Lots of syndicators pitching C grade products and in these different markets that we're speaking to. I mean, in Arizona and different markets in Texas, where the cost per unit now we're talking about, $140,000, $150,000, $160,000 for, again, a C grade product. I mean, do you see the same thing? Is there a major imbalance going on in that lower grade property type?
Yeah. We this morning we had an investment committee call. We passed on 3 C grade properties. One was a 70s product in Dallas, I think it was. And so what happens in the 70s or prior, let's say even low 80s, depending on you can start getting into flat roofs. You can start getting into chiller systems. For a lot of people that don't know, means it's like a central boiler. And so you have a lot of big maintenance costs and a lot of stuff that surround those kinds of things. So we stay away from, you're not going to find that stuff in, some of the newer, but to your point, you can get them for less. You're going to pay less, but your maintenance costs in my operationally, in my experience, are a lot more. Mm-hmm. You're talking about just a tremendous amount of work for that kind of stuff. You can reposition them for sure, but an 8-foot ceiling is an 8-foot ceiling.
Yeah, right.
You just, you can't do much with that. And there are things that you can't do a lot with. You also run into some environmental things back then, with lead paint, asbestos, and things like
Yeah.
that, which we've dealt a fair amount with, on buying stuff, called pre-80s. And then you have the ADA issues, which is American Disability Act. And there's a lot of stuff that, so we as a company have just decided to stay away from any of those and repositioning Cs, unless it's a tear down, you know,
Fair
and
enough.
then which is something that we've actually done before. You just want to rip it down because you love the location, and that's happened in Scottsdale. And so, but I think the reason you're seeing that is a couple things. One, they're chasing a low price per unit, so it still looks attractive, and their capital raising capabilities are limited. So, like for our last 4 deals, we're raising 25 to 30 million for the down payment, and that's what it takes. And Ross and I, we put $1 million of our own money up, non-refundable, in order to secure a deal. And so, if you're starting out as a syndicator, that's got to scare the heck out of
you. Yeah.
And you're probably a little more comfortable in that $10 million equity raise, and you're growing your list and all that. So some of it's probably driven by that, but it stands to reasons. I've seen some incredible people buy some stuff in the 50s and 60s and make it all retro and look good and all that stuff, and I'm constantly surprised. But stuff even here in Phoenix that I was just talking to a guy today, actually, down on what I consider to be one of the sketchiest roads in town. It's crossing the $200,000 a unit number on existing.
Wow.
And you start to look at that stuff, and it's not my cup of tea.
Yeah, I mean, it goes back to the old saying. At least some of it does. Rising tide lifts all boats, and I wonder if when the supply catches up with the demand. I know that we're years out from that, but inevitably, is there future risk in some of these lower grade products? And I guess time.
I always think there is.
Yeah.
I'm with you.
Yeah.
One thing that's never, when I've been through multiple ups and downs in the market. So I got out of college in the late 80s, started in the 90s. I've watched the 90s, the dot-com boom, the early 2000s, and then the one in 2008. And so I've been through the ups and downs. And what I've seen from both a management and ownership standpoint is that corner of Main and Main is always good,
Yeah.
Always. And also sometimes you see these older properties that have these incredible designs, like big units, and and they're kind of cool. They were built really well back in the day. Those properties always do well, and no matter what the age. And so if it's really well designed, really, really well constructed, and really, really well located, my experience has been that you'll never really have a problem. Well, I shouldn't say that never ever, but the 10 that we got rid of, to your point, which kind of started in the beginning, those were not those properties. They were. So for us, they were the problems, and we kept Main and Mains.
Yeah, no, absolutely. It goes back, right? I mean, it's 101, basic real estate investing 101, location.
Yes,
there's some more complexities to it, but really it's from a common sense. I mean, it's that is the number one priority. Location.
Do people want to be there? Period.
Yep, absolutely.
Right? Is it well located, and do people want to be there? That's it.
And so last question for you, Ken, before we wrap things up, I want to be respectful of your time here is, we all talk about the deals that make it to the closing table, the ones that we're incredibly happy about, that have gone as planned. Obviously, there's many more that don't go as planned. We've already talked a good bit in the beginning about those 10 different properties that, for one reason or another, just never met your performance expectations either way. But what I want to ask you is, has there been a deal over the last couple of years, or just it could be over the last 10? It doesn't really make a difference, but that you guys actually felt really good about going into it, You actually got into due diligence on it, and at some point during that due diligence phase, you walked away for one reason or another. And if so, what was that reason? What was the main red flag? And ultimately, that ultimately made you step away from it and pass on the
Yeah.
deal.
Yeah. So very good question. So we really try to avoid that, number one. Like there's, from a credibility standpoint, you really want to try to get all that stuff done. We do a tremendous amount of work on the front end before we make an offer, especially now. You're basically putting hard money out first. And that's kind of where the market's gotten, unfortunately. But usually it has to do with something massively that we find around capital. So it's rarely a market issue, because that's actually kind of the easier stuff. You can say, okay, this is $200 under market that hasn't been touched in 20 years. This is a property that we can upgrade, and based on the existing market, usually pretty good around that. And normally the expenses and everything are pretty well, kind of dialed in. But really what happens is it's the environmental stuff. It's the, could be mold, could be radon, could be, lead paint, could be asbestos, all that stuff. It could be, on a multifamily property, a new roof replacements can be, depending on the size, it could be $500 to $700, $800,000 just for roofs. So you start to look at those kinds of things, or galvanized pipe, where you have, electrolysis, which is when they put copper into galvanized, it creates pinhole leaks in the slabs and stuff like that. So we've had a few of those here and there, but typically we found those during due diligence. And their disclosure issues generally from the seller. So and a lot of times they're not the seller's issue. Sometimes they don't even know. Now, you never really know if that's true or not.
Right.
But so there's been a couple times in our history, but not very many. It's on less than on one hand. And we've done a lot of transactions where it's been something that's been pretty good. Most of the times the seller will say, yeah, I didn't know that. How do you want to handle it? We just kind of navigate through them. But every once in a while, there can be something that's more of an animal that you want. Like in Texas and Arizona, we have what's called expansive soil. And it's, think of quicksand, building on quicksand. Now, you're not supposed to build on quicksand, but expansive soil means exactly what that means. And so what it does is it messes with your foundations. And so you start to see stuff like that, or big drainage issues or things like that are, we're talking about big money where you got to bring in engineers and potentially rip up parking lots and stuff like that. So you do come across things like that, and those might be deals that we walk from.
Yeah, it doesn't sound like it happens all that. A lot of the product you're buying nowadays is newer product. It's built in the past decade or two, and so it might not have a lot of those problems that you've just.
It happens on the seas.
Yeah, it happens on the seas, exactly. Just what we were talking about before, right?
Yeah.
Well, Ken, this has been a lot of fun, my friend. I really appreciate you coming on here, and I know that you've got a lot of different resources and educational material that you offer. So, if you would please share with our listeners how they can not just learn more about you, but
of course.
gain access to all the different things that you have going on out there.
100%. Yeah. So some of you might know, one of our more prominent investors is Robert Kiyosaki, or Rich Dad Poor Dad. So we are good friends. I've known him 20 years now, and so he's like, hey, you got to write some books. I'm like, I don't know how to write. So I started writing the books, and then that turned into more of an education platform, which is kind of aligned with his. And so that's been just a blessing to be able to, provide some of this experience. So I love being able to take all the stuff we're doing at our company and put it up on YouTube and all that. So we have the YouTube channel. We actually have an investor quiz. What type of investor are you? Which they can go to kenmcelroy.com/cashflow-show. So you can go find it there. You can go to kenmcelroy.com, check us out. MC Companies, check us out. Lots of stuff. It's a great time to to learn, be an investor. I think it's the greatest business, Kevin, as you know.
Yes,
I think it provides us so much freedom to be able to spend time with your family, which it should be the point.
Absolutely. Yeah. Just like we were talking about before we start recording. Absolutely. That's exactly why I do it. And I love every bit of it. And I can't imagine doing anything else at this point in my life, you know?
I know.
Been
It's
at
a
it for,
blast
yeah.
going around and finding stuff to buy. And then, everybody's happy. Like when you go inject money into a new property and make it look great, and everybody's excited. And,
Absolutely.
the cities are happy, the town's happy, so it's really fun.
It's a beautiful thing. Very rewarding. Well, Ken, appreciate it again, my friend. Thanks for coming on, and wishing you, continued success and all that you guys do over there. So keep up the great work.
For you, for sure, Kevin. I always appreciate your time, and good luck to you, man. I follow your stuff. It's really fun to watch, and I love it.